Hello, students. Welcome back to our journey in Lesson 8 of Chapter 1. Remember, you're not alone in this. We're right here, dedicated to guiding you every step of the way, helping you not just learn, but truly understand and master this so you can confidently pass your exams. Your support means the world to us. Please take a moment to like, share, and subscribe to the channel so that more students like you can join in and benefit. Let's keep pushing forward together towards success. What is information for a business organization? Information in a business context refers to the data and insights that are gathered, organized, and analyzed to help make decisions. This can include customer data, preferences, buying behavior, financial data, sales, revenue, expenses, market data, trends, competitors, operational data, inventory, supply chain status. Information allows a business to understand its performance, identify trends, anticipate risks, and make well-informed decisions. Think of it as the backbone that supports planning, strategy, and daily operations. 2. Importance of information storage in the modern era. With the rise of digital technology, the ability to store and manage information has become more critical than ever. Here's why. Easy access. Stored information is instantly accessible, enabling quick decision-making. Data analysis. Businesses can analyze stored data to gain insights into trends, customer preferences, and improve processes. Improved customer relations. Information on customer interactions can lead to better service and personalized experiences. Risk management. Stored information helps a business track performance and detect problems early. Regulatory compliance. Many businesses are legally required to keep records for audit and compliance purposes. Information storage is also important because it allows companies to innovate and stay competitive in a fast-changing market. 3. Consequences of not storing information or losing it. If a business fails to store its information or loses it, it can face several serious consequences. Loss of competitive edge. Without information, a business may lose its position in the market, unable to track or react to competitors' moves. Poor decision-making. A lack of data means managers have to rely on guesses rather than facts, increasing the likelihood of poor decisions. Customer trust issues. Losing customer data, especially sensitive information, can lead to a loss of trust and damage the business's reputation. Financial losses. Misplaced information can lead to financial reporting errors, legal issues, and even fines for non-compliance. Operational inefficiency. Without stored data, businesses may struggle with inventory management, supply chain issues, or customer service, which can disrupt operations. In today's era, where data is crucial, not storing or losing information can significantly harm a business's ability to thrive. Information management is not just a tool, but a lifeline for a successful and sustainable organization. Let's start by exploring the history of information storage and how it has evolved over time, especially in today's digital world where big data plays a huge role. 1. History of information storage. Early records. In ancient times, information was stored using primitive methods like cave paintings, clay tablets, and scrolls. For thousands of years, people stored important information on paper, using ledgers and handwritten documents to track finances, trade, and personal records. This process was slow, limited in space, and difficult to duplicate. The Industrial Age. The 1800s and early 1900s introduced advancements like the typewriter and filing cabinets, which allowed for more organized and efficient record keeping. But even then, information was mostly physical, making it prone to loss, wear, and damage. Early digital storage. In the mid-20th century, the invention of computers revolutionized information storage. Early computers used punch cards and magnetic tapes to store data. Over time, we moved to floppy disks, then hard drives, and later compact disks, CDs and DVDs, which could store more data in smaller spaces. The modern era, digital and big data storage. Today, with the rapid expansion of technology, we've entered the age of big data. Here's how modern information storage differs from traditional methods. Digital transformation. Most data today is stored digitally, meaning it's held in electronic form on servers, cloud storage, and databases, rather than on paper or physical devices. This allows massive amounts of information to be stored in relatively small spaces and accessed almost instantly from anywhere. Big data. With the rise of the internet, social media, IoT devices, and smartphones, businesses collect massive volumes of data, known as big data. Big data storage involves complex technologies that store, analyze, and manage vast amounts of data, which would be impossible to handle using traditional methods. Cloud storage. One of the biggest shifts in information storage is the cloud. Cloud storage allows businesses to store data in large server farms located in remote data centers. This means data is not tied to a single device or location, and it's highly scalable, secure, and accessible from anywhere in the world. Data lakes and warehouses. For big data, companies use specialized storage systems like data lakes and data warehouses. Data lakes store raw, unstructured data that can be analyzed later, while data warehouses store structured, processed data for easy access. These systems make it possible to store billions of records and analyze them quickly. How modern storage differs from traditional storage. Capacity. Traditional storage was limited by physical space, while modern digital storage can hold virtually unlimited data. Speed and accessibility. Today, data can be accessed instantly from anywhere, unlike traditional files, which required physical access and took time to retrieve. Data analysis. Modern storage systems are designed to work with data analysis tools. Unlike in the past, businesses can now use their data to predict trends, understand customer behavior, and gain insights automatically. Security and backup. Digital storage allows for encryption, regular backups, and secure storage options, providing far better protection than traditional methods could. Why information storage matters today. In today's world, where decisions are data-driven, modern storage is crucial for businesses to function, grow, and stay competitive. Access to big data allows companies to make informed decisions, personalize customer experiences, and innovate. In summary, the shift from traditional storage methods to advanced digital systems, including cloud storage and big data solutions, has completely transformed how businesses collect, store, and use information. This evolution not only allows for more efficient data management, but also provides the backbone for future innovation and strategic decision-making in today's digital world. All right, let's break down this concept of a company's retention policy and why it's important. Imagine that a business is like a busy marketplace. Every day, people come and go, buying and selling, and each of these transactions creates some kind of record or paperwork that needs to be saved. Now, if the business kept every single record forever, it would soon be buried in a mountain of papers. So, how does it decide what to keep and for how long? This is where a retention policy comes in. Understanding a retention policy. 1. What is it? A company's retention policy is a set of guidelines that says how long different types of information or documents should be kept. This includes everything from financial records, customer receipts, and employee information to contracts and legal documents. Think of it as a set of rules that tells the business when it's okay to throw something away or delete it, and when it should still be kept. 2. Why is it important? There are two main reasons why businesses need a retention policy. Security. Keeping unnecessary information around can create risks. For example, if sensitive customer information is kept for too long, it could be lost or stolen. Availability. The policy ensures that important documents are kept long enough to be available when needed. Imagine if a business had no record of its past transactions. It would be very difficult to check past accounts, settle disputes, or prove compliance with the law. Handling business paperwork. Every transaction a business makes generates some kind of paperwork, and this paperwork needs to be handled properly. This means organizing it. Information should be sorted and stored correctly so it can be found easily when needed. Storing it securely. Sensitive documents must be stored in a secure place, such as a locked file or an encrypted computer system. Ensuring access. The right people should have access to the information, but it should be protected from anyone who doesn't need to see it. In short, a company's retention policy is like a roadmap that tells the business which information to keep, where to store it, and when it's okay to let it go. This not only keeps the business running smoothly, but also protects it from risks and ensures it's ready to respond whenever information is needed. In any business, managers constantly need information to make informed decisions, plan ahead, and keep operations running smoothly. Let's look at the 4 main types of information they often require and why each one is so valuable. 1. Records of past and current transactions. What this means. This type of information includes details of every transaction or business activity, like sales, purchases, or payments that have happened over time. These records might still be in process, awaiting confirmation, or already completed but stored for future analysis. Why it's needed. Managers often need to confirm that transactions were handled correctly, or look back at these records to understand past business activity. Example. Imagine a clothing store that keeps records of every item sold. These records help the manager know which products were popular last season and which weren't. If a manager sees that blue jeans sold more than any other item last season, they might decide to stock up on them again in preparation for the next season. 2. Information on past trends and current operations. What this means. This information helps managers understand patterns from the past and the current status of business activities. It's used as a foundation for planning future actions and making decisions. Why it's needed. Managers use trends to predict what's likely to happen in the future, and they adjust operations accordingly. This type of information helps them avoid shortages or excesses in inventory and ensures that operations are efficient. Example. Let's say a manufacturing company looks at how quickly its raw materials, like metal or plastic, are used up each month. By understanding the past rate of consumption, they can plan ahead for future orders. If they know they go through 100 pounds of plastic each month, they'll make sure to order enough each month to avoid delays in production. 3. Routine transaction information for current operations. What this means. This is the day-to-day information needed to carry out ongoing tasks. It includes all the details required for routine activities, like processing customer orders and restocking inventory. Why it's needed. Routine transaction information helps managers and staff make quick, accurate decisions on a daily basis to keep operations flowing. Example. In a warehouse, if a customer orders 50 units of a product, the manager needs to know how many units are available in inventory, when they can be shipped, and how they'll be paid for. This information ensures that the order is fulfilled on time and that the correct payment and delivery arrangements are made. Information on performance for comparison and control. What this means. Managers need performance data to compare actual results with the company's plans, budgets, and forecasts. This information allows them to check for any discrepancies and make corrections where necessary. Why it's needed. Monitoring performance helps managers control operations by identifying areas that are off track. If something is underperforming, they can take corrective action to address the issue. Example. Suppose a company budgeted $10,000 for advertising this month, but actually spent $12,000. This difference might indicate overspending, and the manager could investigate why costs were higher than planned. This control function allows the manager to keep spending in line with the budget or make adjustments to improve efficiency. Bringing it all together. In summary, a business organization has a constant need for information because it allows managers to verify past transactions and ensure accuracy, understand trends to plan future inventory or production needs, make daily operational decisions based on up-to-date transaction data, track performance against targets and budgets, making adjustments to stay on course, Each type of information serves a unique role in keeping the organization on track, and without access to accurate information, it would be difficult for managers to make the best decisions for the company's growth and stability. Let's explore who outside of an organization needs information from it, why they need it, and how this benefits both the organization and these external parties. For a business to operate smoothly and successfully, it often needs to share certain information with people and groups outside of its own employees and managers. This is not only a matter of transparency, but is often required for efficient, ethical, and legal operation. Here are the main external groups who need information from a business. 1. Other parties involved in transactions, customers, suppliers, and subcontractors. Who are they? These are groups that the business directly interacts with for its operations. Customers buy products or services from the business, suppliers provide the raw materials or products the business needs, and subcontractors might handle specific parts of the business's work. What information do they need? Customers often require information about their orders, delivery details, and payment options. Suppliers need to know about purchase orders, delivery dates, and any special requirements for the goods they supply. Subcontractors need clear instructions and deadlines on what they are supposed to do, whether it's delivering a product or completing part of a project. Example: imagine a construction company working on a big project. It orders building materials from a supplier and contracts electricians, plumbers, and other subcontractors. The company must provide accurate information about the project timeline and specific materials needed so that the contractors and suppliers can fulfill their roles correctly. Any mistake or delay in sharing information could lead to costly project delays or errors. 2. Parties interested in financial performance, shareholders, investors, and accounts payable. Who are they? Shareholders, people who own shares or stocks in the company. They're part owners of the business and have a right to know how well the company is performing. Investors, people or entities considering putting money into the business. They need reliable information to decide if the business is a good investment. Accounts payable, banks, creditors, or anyone else the business owes money to. They need to know the company's financial health to ensure it can repay its debts. What information do they need? Shareholders and investors often look at financial statements like profit and loss accounts and balance sheets to see if the company is profitable. Creditors may require detailed financial information to assess the risk of lending more money or to set the terms of repayment. Example: if a manufacturing company wants to expand, it might need additional financing from investors. These potential investors would want to see accurate financial reports that show the company's current revenue, profit margins, and growth potential before deciding to invest. If the business isn't transparent, investors may hesitate, fearing the risks of investing in an unknown financial situation. 3. Outside agencies, government bodies and tax authorities. Who are they? Government departments, regulatory agencies, and tax authorities that monitor business activities to ensure compliance with laws and regulations. What information do they need? Government bodies may require data for economic surveys, environmental impact assessments, or industry compliance. Tax authorities need financial data to assess the company's tax obligations. Example: suppose a company operates in an industry that produces emissions. Regulatory bodies might need regular reports on the company's emissions to ensure it complies with environmental standards. Additionally, every year, the company must submit accurate tax reports to tax authorities. Failure to provide this information could result in fines or legal action. Bringing it all together. In essence, sharing information with these external parties is vital for several reasons. It builds trust and enables smooth transactions with customers, suppliers, and contractors. It ensures accountability to investors, shareholders, and creditors who rely on transparent financial performance to make informed decisions. It maintains compliance with government and regulatory bodies, which is crucial for legal operation and avoids penalties. Without effective communication with these external groups, a business risks operational delays, financial setbacks, or even legal trouble. By providing the necessary information, the organization can maintain strong, reliable relationships with each group, ensuring mutual benefit and stability. Let's go through this text in detail, focusing on understanding each point thoroughly and how it applies in a business or organization setting. 1. Personal or interpersonal information for inquiries and complaints. What this means. This refers to the type of information exchanged directly between individuals when dealing with inquiries, requests for information, or complaints. When people have questions, complaints, or specific issues, they need clear, direct responses. This might include personal introductions, explanations about products or services, apologies if there was a mistake, and answers to questions. Why it's important. Interpersonal communication is crucial in handling inquiries and complaints, as it creates a sense of understanding and respect between the organization and the people it interacts with. This approach helps build trust and can resolve issues effectively, making customers or colleagues feel heard and valued. Example. Imagine a customer who bought a laptop that doesn't work properly. They call customer service to complain. The customer service representative introduces themselves, listens to the issue, explains what might have gone wrong, apologizes for the inconvenience, and offers a solution, like arranging for a repair or replacement. This kind of personal interaction helps solve the customer's problem and leaves a positive impression of the company's support. 2. Information provided by an employee about themselves. What this means. This includes all the personal information an employee shares with the organization, especially during hiring. It could be in the form of a job application, resume, curriculum vitae, or during interviews. Once hired, this information is stored in the organization's records for reference and administrative purposes. Why it's important. Employee information is essential for various reasons, like determining qualifications for the role, creating a record for legal and HR purposes, and ensuring that the organization can contact or support the employee if needed. This information is also critical for tracking employee history and performance. Example. When an individual applies for a job, they provide details about their education, work experience, and skills in their resume. If they're hired, this information becomes part of their official employee record, which HR uses for managing payroll, benefits, and performance evaluations. If the employee later applies for an internal promotion, the organization can quickly check their qualifications based on these records. 3. Information provided to employees about the organization. What this means. This includes all the information that the organization shares with its employees to help them understand the company's operations, their role within the system, and any updates or changes. It might be provided through training, documents like employee handbooks, internal memos with important updates, or regular staff meetings. This is usually part of onboarding, also called induction, when employees first join the company. Why it's important. Informing employees about the organization and their role helps them feel more comfortable and prepared in their job. It provides clarity about expectations, introduces them to the company's culture and goals, and can motivate them by showing their place within the larger structure. Example. A new employee at a manufacturing company might attend an induction session where they're introduced to the company's history, goals, and safety procedures. They might also receive a training manual with instructions on how to operate certain machines. Regularly, the company may send out memos to update employees on safety protocols or hold meetings to discuss productivity goals. This keeps employees aligned with the company's objectives and helps them understand how they contribute to its success. Bringing it all together. Personal or interpersonal information exchanges are essential in a business because they enable smooth operations and foster trust and communication between different parties. Each type of information serves a unique purpose. Direct communication for inquiries and complaints helps resolve issues and strengthens relationships with customers and colleagues. Employee-provided information allows the organization to understand and manage its workforce effectively. Information given to employees ensures they are well prepared, motivated, and aware of their responsibilities within the company. Each of these interactions plays a key role in ensuring that the organization runs smoothly, employees are supported, and customers feel valued. Let's go through each type of information handled in an accounts department to understand why it's critical for smooth operations, legal compliance, and effective financial management. 1. Incoming correspondence. Explanation. Incoming correspondence refers to all types of communication coming into the accounts department from people or entities outside the organization, including letters, emails, memos, and reports. These could be from clients, suppliers, government agencies, or other departments within the same organization. Purpose. This information is handled and stored to ensure action. The department needs to act on certain messages, responding to inquiries, completing transactions, or providing information as requested. Analysis. Some correspondence may need to be analyzed to understand its implications on the company's financial health, like a request for bulk orders, which would impact inventory and cash flow. Confirmation. Incoming correspondence serves as proof of communication received from outside parties, providing a record of claims, requests, or obligations. Example. Suppose a supplier emails the accounts department to confirm an order and send an invoice. This email needs to be stored to ensure the accounts team has a record of the transaction terms, the total amount, and payment deadlines. If there's a dispute later, say over payment terms or quantity, the team can refer back to the stored correspondence to clarify the agreement. 2. Outgoing correspondence. Explanation. Outgoing correspondence includes emails, letters, memos, reports, or any documents the accounts department sends out to other departments or external entities. This could include responses to supplier queries, payment confirmations to vendors, or internal memos. Purpose. Outgoing correspondence needs to be managed and stored to serve as evidence. Keeping copies of outgoing communication provides proof of what the organization or department has communicated. This is critical if questions arise about what was agreed upon or instructed. Provide confirmation. Stored outgoing correspondence confirms that specific instructions, payments, or responses were sent, helping avoid any miscommunication. Example. If the accounts department sends an email to a client confirming that their payment was received, this email should be stored. Later, if the client claims they didn't receive confirmation, the accounts team can easily retrieve this stored email as evidence that the confirmation was indeed sent. 3. Financial records. Explanation. Financial records are all the documents generated or received as part of transactions and reporting. This includes invoices, receipts, ledgers, payroll records, and financial statements. These records form the backbone of financial data in any organization. Purpose. Financial records are stored and managed to aid in planning and control. Access to financial records allows the department to review past transactions, budget accurately, forecast cash flow, and manage expenditures. Meet accountability requirements. External agencies, such as tax authorities, regulatory bodies, or auditors, require organizations to keep accurate financial records for compliance purposes. Legislation often mandates the storage of these records for a specified period. Example. If the accounts department processes payroll, they generate records showing salaries, deductions, and net pay. These records need to be stored securely because they're essential for managing budgets, planning future payroll expenses, and providing proof of payroll compliance during audits. Additionally, if an employee has a question about their pay, the accounts team can refer to these stored records to clarify. Bringing it all together. Each of these types of information, incoming correspondence, outgoing correspondence, and financial records, has distinct roles in supporting an accounts department's efficiency, legal compliance, and financial control. Incoming correspondence allows the department to track requests and interactions with outside entities. Outgoing correspondence ensures that the department has records of communications sent, protecting the company from potential disputes. Financial records support accurate financial planning and control while ensuring compliance with legal and regulatory standards. Example for all three types together. Imagine an accounts department receiving an email, incoming correspondence, from a supplier with an invoice for a recent bulk purchase. The accounts department then sends a confirmation email back to the supplier, outgoing correspondence, after processing the payment. The invoice, payment confirmation, and all records of this transaction, financial records, are stored together. This organized storage provides a complete record of the transaction, ensuring clarity, protecting against disputes, and helping with future planning. Each type of information requires specific handling and secure storage, ensuring both the department's efficiency and the company's long-term financial stability. Retention policy, understanding the types of files and their storage. In an organization, data and information are managed in a structured way, especially when it comes to file retention. These files are categorized based on how long they should be kept and how frequently they are used. The retention policy helps determine which files are permanent, temporary, active, or non-active. Below is a detailed breakdown of each category with examples to make it easier to understand. 1. Master files and reference files, permanent files. Explanation. These are files that store essential foundational information that the organization needs to keep indefinitely. These files are never thrown away because they contain critical data that supports ongoing operations. Purpose. These files are updated over time, but the files themselves remain part of the company's records. They act as a reference for many operations in the future. Examples. Customer master file. This file contains information about all customers, e.g., name, address, contact details, credit history. Even though a customer's contact information may change over time, the customer's file will continue to exist and be updated. This allows the company to track historical interactions and maintain a complete record of the customer. Employee master file. This file holds personal data of employees, e.g., name, address, employment history, salary details. This file stays with the company even after an employee leaves, as it may be needed for legal reasons, e.g., tax reports or pension plans. Why permanent? This is because the information in these files is foundational and often has legal or regulatory requirements that necessitate long-term retention. Even though the information may change, like a customer's address, the file itself continues to hold value over the years. 2. Temporary or transitory files. Explanation. Temporary files are used for short-term storage. They usually hold data or records related to specific transactions or activities that are only needed for a short period before they are discarded. Purpose. These files typically serve a single purpose during a transaction and are not required for future reference once the task is completed. Examples. Receipt files. These are temporary files that store receipts for purchases made during the year. Once the receipts have been processed into the accounts and the financial reports are finalized, these files may be discarded. Project-specific files. For instance, if an event is held, files with planning documents, emails, and other event-related data may only be kept for the duration of the project. Once the event is over, the file is no longer needed and is scrapped. Why temporary? These files are generally not needed once the transaction or event they relate to is finished. For example, a project that was completed months ago doesn't require ongoing records once all expenses and payments have been processed. 3. Active files. Explanation. Active files are files that are frequently accessed and used on a daily basis. These files are essential for current operations, and their data is regularly updated to reflect ongoing business activities. Purpose. Active files are used to manage and monitor the company's day-to-day operations, and they must be readily accessible because they contain current, up-to-date information. Examples: sales invoice files. These files contain invoices for products or services sold during the current financial year. Sales teams or accountants may need to access these files frequently to process payments, resolve disputes, or track sales progress. Customer correspondence files. This could include emails, letters, or contracts with current customers. These files are often accessed for quick responses or to review agreements. Why active? These files are in constant use because they pertain to ongoing business transactions. For instance, invoices are processed regularly, and customer correspondence needs to be tracked to maintain relationships and ensure smooth business operations. 4. Non-active files. Explanation: non-active files are those that are no longer in regular use. These files may contain outdated or obsolete information, but they still have some value. They are kept for reference or legal reasons, even though they are not frequently accessed anymore. Purpose: non-active files are typically stored for historical records, compliance with legal obligations, or other long-term purposes. They may be referenced occasionally, but are not part of the daily workflow. Examples: old customer files. This could include records of customers who no longer do business with the company. Even though no new transactions are taking place, the information may be kept in case of future legal inquiries or customer reference needs. These are files containing tax documents from previous financial periods. The tax authority might still request them for audits, but they are no longer used in daily operations. Why non-active? These files are no longer required for daily activities, but may be needed for future reference or compliance. For example, old tax returns may be required for auditing purposes, even though they're not relevant to current operations. Semi-active files. Explanation: semi-active files are files that are on their way to becoming inactive. These files are not used regularly anymore, but still have ongoing relevance or could be needed for reference in the near future. Purpose: these files may not need to be accessed every day, but they should be stored and easily retrievable if needed for special situations or specific queries. They may still hold value, but are gradually becoming obsolete. Examples: contracts near completion. If a contract is nearing its end, the associated files may not be accessed frequently, but they should be kept on hand in case a dispute arises or for future reference. Past financial year data. As the financial year concludes, some files related to the previous year's accounts may no longer be used on a daily basis, but could be referred to for analysis, tax purposes, or comparison with the new year. Why semi-active? Semi-active files are in transition. They may be less frequently used, but they still hold value as they might be referenced in specific situations, like analyzing past trends or resolving issues that were raised earlier. Why this categorization matters. The categorization of files, permanent, temporary, active, non-active, and semi-active, helps organizations manage their information effectively. By identifying the type of file, an organization can determine how long to keep. It ensures that only necessary files are kept for extended periods, while unnecessary files are discarded in a timely manner. How to organize. It helps decide how to store files, e.g., physical storage, cloud storage, or database management, based on their frequency of use. Compliance ensures the company is compliant with legal or regulatory retention requirements, e.g., financial records that must be kept for a certain number of years. Example for all categories. Let's say a company has a customer master file, permanent, that contains a list of all clients and their details. While that file remains permanently in the system, there may be an order transaction file, temporary, for a one-time order from a customer that will be scrapped once the order is complete. The company will keep current year sales invoices active in one folder, while older customer files, non-active, will be archived and kept for reference. Lastly, a contract nearing completion might be placed in a semi-active file where it's kept for occasional reference, but not accessed daily. By organizing data in this manner, businesses can ensure they manage their information efficiently, save resources, and comply with necessary regulations while maintaining a clear, accessible record system. Handling information that is no longer needed on a daily basis. When information contained within files is no longer needed on a daily basis, organizations don't automatically throw them away. Instead, they adopt one of the following practices to manage these records. This process ensures that important information is preserved in a systematic way, either for future reference, compliance, or for historical reasons. The three main methods for handling files that are no longer actively needed are 1. Microfilming or microfiching for long-term storage. Explanation. Microfilming and microfiche are techniques for creating miniature photographic versions of documents, allowing large amounts of information to be stored in a very small space. These forms of storage are often used for documents that need to be preserved for long periods but aren't regularly accessed. Purpose. These methods are useful for storing historical documents, legal records, or any files that must be kept due to legal, regulatory, or archival requirements, but are unlikely to be referenced frequently. Example: legal contracts. A company might have signed contracts that are no longer relevant to day-to-day operations, but must be kept for a certain number of years for legal reasons, e.g., contracts related to partnerships, patents, or financial agreements. Instead of keeping physical copies that take up space, the company might microfilm these documents. By storing them in a compact form, they can be easily retrieved in the future if needed, without requiring a lot of storage space. Historical records. Government agencies, for instance, might use microfiche to store records like old land deeds or census data. Even though these records may not be frequently used, they must be preserved due to their historical importance. Why microfilming or microfiching? Space efficiency. Microfilms take up much less space than physical files. For large archives of documents that must be kept for many years, this is a cost-effective solution. Durability. Microfilm can last decades without deteriorating, making it ideal for storing documents that need to be preserved long-term. Retained in its original form and stored elsewhere. Archiving. Explanation. When files are no longer needed for daily operations, but still have value for legal, financial, or historical reasons, they can be moved to archive storage. This involves storing them in their original format, whether physical paper or digital, in a secure location. Purpose. Archiving is a way to free up valuable space in the active filing system, while still keeping the documents accessible if needed in the future. It also ensures that records can be retrieved easily if necessary, often after a predetermined period. Example: employee records. Imagine a company has a file containing employment records of employees who have retired. These records are not actively used, but are important for future reference, such as for pension verification, tax audits, or insurance claims. The company can archive these files by moving them to a separate storage room or digital cloud system, where they can be kept for a number of years. Project files. A construction company may have completed project files that contain detailed drawings, permits, and correspondence. Once the project is finished, these files might not need to be accessed regularly, but must be stored for future liability or insurance purposes. Instead of keeping them in the active filing area, the company moves them to an archival system. Why archiving? Organized storage. Archiving allows an organization to maintain documents for long periods without them cluttering up the day-to-day operational filing systems. Easy retrieval. Archived documents are organized systematically, allowing for easy retrieval in case they are needed for audits, legal inquiries, or other reasons. 3. Securely destroyed. Explanation. When files are no longer needed and there are no legal or regulatory reasons to keep them, they are securely destroyed to protect sensitive information and ensure that it is permanently removed from the system. Purpose. The destruction of files is an essential part of information management. It helps reduce the risk of data breaches and ensures that personal, confidential, or proprietary information doesn't fall into the wrong hands. Sensitive data. Destroying files is particularly important when dealing with sensitive information, such as customer data, employee personal information, or company secrets. This reduces the potential for identity theft, fraud, and other legal complications. Example: old customer data. A retail company might have customer credit card information on file from years ago. If these transactions have been completed and there are no ongoing business relations with those customers, the company may securely destroy the paper or digital records containing that sensitive data to prevent misuse. Employee personal information. After an employee leaves the company, their personal records, e.g., address, bank details, medical information, might no longer be needed. However, these documents must be securely shredded or permanently erased from the system to ensure confidentiality. Why secure destruction? Data security. Ensuring that personal and confidential data is destroyed properly minimizes the risk of identity theft and keeps the organization in compliance with privacy laws such as GDPR, General Data Protection Regulation. Legal compliance. Some countries and industries have strict rules about how long certain records should be kept, and others require documents to be destroyed after a certain period to protect privacy. The importance of a retention policy. A retention policy is a crucial framework for any organization. It sets out clear rules for how long different types of information should be retained and when they should be discarded, archived, or destroyed. This policy helps to ensure that the organization maintains compliance with legal and regulatory requirements regarding the retention of records, prevents overaccumulation of outdated documents, which could become a liability and a waste of storage space, improves efficiency by clearly designating how long information needs to be kept and when it can be removed from the active system. Examples of how the retention policy is applied. 1. Medical practice. Medical records for patients need to be stored for a certain number of years after their last visit. The retention policy might specify that after 7 years, these records can be archived or destroyed, depending on patient consent and legal requirements. Records that are no longer active, e.g., completed medical treatments, are either archived for future reference or destroyed once the retention period ends. 2. Financial institution. Banks are required by law to keep records of financial transactions for a number of years, such as tax filings or loan documents. These records may be microfilmed for long-term storage or archived digitally in a secure, centralized location. Once the retention period is over, records like old bank statements may be securely destroyed to prevent identity theft. 3. Government office. A government office might have tax records that need to be stored for decades. These files could be microfished for long-term storage. After a certain period, if these files are not being referenced often, they would be stored in archived locations. If records are outdated and there's no longer a legal requirement to retain them, they might be shredded to ensure sensitive information is protected. The dangers of not having a proper retention policy. Legal issues. If an organization doesn't properly manage its retention policy, it could face legal consequences if it is unable to produce required documents during audits or litigation. Storage clutter. Failing to archive or destroy outdated records can lead to a cluttered and inefficient storage system. This makes it harder to locate important documents and slows down day-to-day operations. Security risks. Improperly discarded files can lead to data breaches or the exposure of confidential information, which can harm the organization's reputation and lead to legal consequences. Conclusion. The methods used to handle files that are no longer needed on a daily basis, microfilming, archiving, and secure destruction, are crucial components of a robust information management system. Each method ensures that information is handled appropriately depending on its relevance and legal requirements. A well-designed retention policy helps organizations manage data efficiently, comply with regulations, and maintain security, all while avoiding the unnecessary clutter of outdated records. Understanding retention periods for different types of documents. Retention periods are a critical component of an organization's information management and legal compliance policies. These periods define how long various types of documents must be retained before they can be discarded or archived. Retention periods can vary depending on legal requirements, organizational needs, and industry-specific standards. Different types of documents have different retention periods, which can range from temporary storage to permanent retention. Let's break this down in detail, using the UK Companies Act and other relevant legislation as examples to understand the retention periods for various documents. 1. Documents concerned with the legal establishment of the organization. Permanent retention. Explanation. Certain key documents related to the establishment of a company must be kept permanently. This is usually to comply with legal requirements or to maintain a historical record of the company's formation. Examples: Certificate of Incorporation. The document that formally establishes a company as a legal entity in the eyes of the law must be kept permanently. This serves as proof of the company's legal existence and is required for various legal purposes. Memorandum and Articles of Association. These foundational documents define the company's rules and objectives. Since they outline the company's structure, governance, and operational principles, they must be retained for the entire lifespan of the company. Why permanent retention? These documents are essential to demonstrate the legitimacy and legal framework of the organization. They might be needed for legal actions, audits, or other official procedures that could arise during the company's operations. 2. Annual accounts, permanent retention. Explanation. Under the Companies Acts in the UK, annual financial statements, which include the balance sheet, income statement, cash flow statement, and accompanying notes, must also be kept permanently. Examples: financial statements. These records provide a detailed snapshot of the company's financial position and performance over a specific period. They are required by law to be maintained for historical reference and for audit purposes. Audit reports. Audit opinions and the auditor's report are also part of the permanent records, since they verify the accuracy and compliance of the company's financial statements. Why permanent retention? Financial history. These records provide crucial insights into the financial health and history of the company. They may be used for legal proceedings, shareholder meetings, or regulatory inspections in the future. Compliance and verification. Governments and regulatory authorities require companies to produce these records as part of ongoing financial compliance and taxation. 3. Simple legal contracts, 6 years. Explanation. Simple contracts, which are generally straightforward agreements between parties, such as standard business contracts, typically need to be kept for a defined period, commonly 6 years under UK law. This period ensures that the contract can be referred to in case of disputes or legal actions. Examples: supply contracts. A company might have an agreement with a supplier outlining the terms of the supply of goods or services. If a dispute arises or the terms of the agreement are questioned in the future, the contract should be available for review. Employment contracts. Contracts with employees, which outline the terms and conditions of employment, should be kept for 6 years after the termination of employment, in case any employment disputes or legal claims arise. Why 6 years? The 6-year period aligns with the typical limitation period for most contract-related legal actions. This means that, under UK law, an individual or organization generally has up to 6 years to bring a legal claim regarding a contract. 4. Sealed contracts. Retention period. Explanation. More significant contracts, especially those involving legal matters that are more complex or that carry greater financial implications, need to be kept for 12 years. These contracts are usually sealed, which means they carry a formal legal weight. Examples: property deeds. If a company enters into a legal agreement to buy or sell property, such a contract will typically be sealed and should be retained for 12 years. This allows for reference if there are issues related to the property or its ownership in the future. Long-term service agreements. Some contracts that last for many years, such as long-term leases or franchise agreements, may also be sealed and need to be kept for 12 years in case disputes arise later regarding their terms. Why 12 years? The 12-year period allows for a long statutory limitation period in case there are disputes over the validity of sealed contracts. Sealed contracts often involve higher stakes and can have far-reaching legal consequences, making it essential to retain them for longer periods. 5. Tax legislation and minimum retention periods. Explanation. Tax laws may specify the minimum retention periods for various financial records that are critical for tax reporting, auditing, and compliance purposes. These records often have to be retained for several years to ensure that a company is in compliance with tax laws and can verify its financial transactions when requested by tax authorities. Examples: invoices and receipts. A company must keep records of all its sales and purchase invoices for a certain period, usually 5 to 6 years, as these are necessary for tax purposes, such as income tax or VAT returns. Tax returns. Copies of submitted tax returns and any supporting documents, such as bank statements or payroll records, must be retained for a specified number of years, typically 6 years after submission. Why retain for a specific period? Audit and review. Tax authorities may audit the company's accounts and financial dealings. Keeping these records ensures that the company can prove that it has paid the correct amount of taxes and adhered to tax laws. Statutory compliance. Failure to comply with these retention periods could result in penalties or fines from the tax authorities, or a lack of necessary documentation to resolve a tax dispute. 6. Public bodies and permanent record keeping. Explanation. Certain public bodies, e.g., government agencies or public sector organizations, are legally required to keep certain records permanently. These records might need to be available for public inspection or for the historical record. Examples: government legislation records. Bills, acts, or regulations passed by the government need to be preserved permanently for public access and future reference. These are crucial for the transparency of governmental processes and for legal research. Court decisions. Records of court cases, judgments, and legal proceedings are maintained permanently for historical purposes and public access. Why permanent retention? Public access and legal precedent. These records may serve as the foundation for future laws, legal decisions, and policy making. They may also be required for historical documentation, reference, or research. 7. Discretionary documents. Explanation. Some documents may not have a legal or regulatory requirement for a specific retention period, and the decision on how long to keep them is left to the discretion of the organization. Examples: internal memos. Memos regarding internal meetings or discussions that do not pertain to legal obligations but are used for reference might be kept as long as they are useful. Marketing materials. Brochures, advertisements, and promotional materials may not have a fixed retention period and can be discarded when they become obsolete or irrelevant. Why keep them? The general principle is, if you think you might need it, keep it for as long as you might need it. This allows organizations to retain useful information even when not legally obligated to do so. In conclusion, retention periods for various documents are determined by legal requirements, the nature of the document, and the organization's needs. Documents like legal contracts, tax records, and financial statements may have specific retention periods set by law, while others may be kept at the organization's discretion. A good retention policy ensures that important documents are preserved for the right length of time, while irrelevant or outdated documents are either archived or securely destroyed, minimizing clutter and maintaining legal compliance. Thank you so much for watching. I hope you found the lesson helpful. We'll see you soon in Lesson 9, so make sure to stay tuned and keep up the great work. Don't forget to like, share, and subscribe to support the channel. Take care and see you next time.